we just wait for the rest of the participants to join us, all right? Everybody, if you can hear me loud and clear, kindly drop an emoji in the group so that I know that you guys can hear me loud and clear. Okay, all right, beautiful. So here we go, guys. It's now the purpose of this session that we are having is because over the past couple of weeks, a lot of people have requested and asked me questions, regarding news activities or news releases, all right, and how the fundamental factors can influence, money in general, all right, in how fundamental factors influence the economic value or what we observe on our price charts, all right. So I've had a ton of questions in the last couple of weeks, okay, and this session is a response, all right, is in response to those questions that I have been asked time and again, all right. So I am hoping that through this session, many of you will be able to find answers to that question that you have repeatedly asked me, all right. And not just that, I hope that you would understand it clearly enough, all right, even to be able to teach other people, all right, and to be able to apply whatever you're going to be learning tonight in your own trading careers. All right. So without further ado, let us get just right into the session. So once again, you're welcome. My name is Adetola Freeman, as you already know, and I am the lead instructor of EasyFX Academy. So we're going to get into, fundamental factors influencing money, all right, influencing the price on the chart as a trader. But before we do that, it's important that I clarify certain things. Okay, the first concept that you guys are going to need to understand clearly, all right, is the fact that there is a fixed supply of money, all right, or let me say, let me start like this, value, all right, let me start like this, value is actually supposed to be equal to money. All right, in an ideal circumstance, all right, or in an ideal market, value is supposed to be equivalent to money. All right, which means that no economy should be more should have more money, all right, than the value they provide. Okay, and this is why you often see that so many countries engage in exports and international trades and all of this kind of transactional cross-border transactions, all right, because they are simply trying to be able to provide value to more economies, all right, because based on how much value they provide, all right, is what increases the value or the weight or the influence of their currency, all right. That is why you see that when countries engage in more frequent exports, all right, which means that they are providing something valuable to other countries, all right, to other economies, all right, their GDP is observed to improve, all right, is observed to do better, okay? So ideally, value is supposed to be equivalent to money, all right? However, because the markets that we trade currently, all right, the state of the market at this point is no longer ideal. All right. As a result, value is no longer directly equivalent to money. And I'm going to explain. The main reason, or one of the key reasons why value is no longer directly equivalent to money, or why there's a disparity between value and money, all right, or intrinsic value and monetary value, is because in the real sense of things, okay, there are certain economies that choose to print more money. All right, I want you to understand that, all right. For example, in the US, this is one of the practices that they have, oftentimes, okay. So they print more money. And when they print more money, it is not as though they are increasing their value, the value they provide. All right. It's not like they are providing increasing value. It is just the fact that they are printing more money. All right. The money that they are printing, I want you to understand how it is going to affect their stand in the international markets. All right. Because what you trade is the international markets. You trade GBP USD, you trade Euro USD. It's an international market. You're trading, the currency of an economy, which is the European Union, all right, against the currency of another economy, which is the United States, all right. So when a country begins to print more money, what actually happens is that the value, the money they have in circulation, all right, becomes greater than the value of that country or of that economy. And what happens? It means that the value begins to, the money, all right, begins to lose value. All right, because now there's a disparity between the intrinsic value and their monetary value. All right, and as a result of that, their monetary value will have to reduce and drop so that it can become paired with their actual intrinsic value. If you understand what I've explained so far, kindly drop an emoji in the group, all right, so that I know that I'm being understood as I desire to be. So if you understand what I've explained so far, please drop an emoji in the group. Let me be sure that you guys are following. All right, beautiful. Oshatokwe, thank you. Beautiful. Okay, so now that we understand this, okay, you realize that another thing you need to understand is this. When it comes to borrowing money, all right, when it comes to borrowing money, how does borrowing, all right, loans and the likes, all right, how does it influence or affect an economy? That's the next big question. All right. So when a country goes out there, all right, to lend money, all right, or to borrow money rather, or when when institutions, when organizations in a country, all right, begin to reach out to banks and financial institutions to borrow money, how does this borrowing affect the economy? All right. The answer is simple. Remember, people who borrow money, all right, they are supposed to be borrowing money for investment purposes. All right. They are supposed to be borrowing money to invest. And based on their investment, it is expected that they should have returns on investments. All right. It's expected that these guys should be able to have a certain amount of ROI, a percentage that is given to them as interest that accrues to their investments. All right. So what happens is this. We expect that because you're borrowing, all right, when you borrow and invest in a productive venture, all right, we expect that you will make interest, all right, as profit. And since we are the ones borrowing you money, we expect that when you want to return our money to us, all right, you are supposed to also return it with some amount, all right, with some degree of increase, all right. So what happens when you borrow money or when companies borrow money? When an industry or an organization or a financial institution borrows money, all right, the next thing they start to do is they start to look for, improving economies, all right. They start to look for promising environments where they can invest their money, all right. They start to look for promising environments to invest their money. And that brings us to the financial cycle, all right, the financial cycle. What is the financial cycle? One, we talk about the forex market, all right, the foreign exchange market, all right. Two, we talk about stocks, all right. And then three, we talk about crypto, All right. So we have forex or currency markets. All right. We have stock, and then we have crypto markets. All right. So when investors borrow from financial institutions, what they check is they are looking for which of these things, all right, is going to give them the most promising returns. All right. Which of this is going to give them the most promising returns? Now, this is where the problem comes. All right. I'm still going to show you how to understand or interpret all of this, all right, from the chart. Okay. But first of all, I want you to understand the basics. All right. This is economics. But when you understand macroeconomics, it becomes easier to interpret news because you know what to expect from the impact of those news publications. All right. So how many of you are, you've wondered how interest rate influences forex? How many of you have ever wondered that? If you have ever at any point in time wondered why interest rates influences the economy, all right, or influences prices on the chart, can you drop an emoji in the group? Let me check. Let me see those who have, actually have an idea of, the financial markets or, fundamental factors. So they tell you, oh, there's interest rates decision, there's CPI, all right, which is consumer price inflation. They tell you, oh, the Feds are going to be talking about interest rates, all right, the Bank of England or the Bank of Japan, all right. You get to hear all of this talk about interest rates, all right, and you wonder why does it affect the market the way it affects the market, all right? It's an interesting question, and I'm going to be giving you the answer to that tonight, okay? So when an investor comes here and borrows money, okay, he is borrowing because he expects to find a market where he can invest that money and make the most, the most returns. All right. That's not exactly true. Puzo said the higher the interest rate, the lower the rate of buying the currency. That's not exactly the way it works. I'm going to show you how it works. Okay. I'm going to show you how it works. But thanks for that contribution. Thank you for that. So when an investor borrows money, all right, when an investor borrows money, the next thing that happens is this. The banks, all right, when they believe that when the people borrowing out the money or lending the money, when they believe that, the economy is performing well, all right, and you can basically invest in any vehicle, all right, they increase interest rates. I want you to listen to me carefully, all right? They increase interest rates because they believe that, there are things that you can put money into right now, all right, that will yield well, all right? Or two, in order to ensure that the monetary value and the intrinsic value are equal, in order to balance it, all right, they try to prevent more money from entering the economy when there is no increase in value, all right? So they increase interest rates to make sure that investors don't spend anyhow without investing in value. All right. So that when you borrow money from a bank or a financial institution, all right, as you are borrowing money from them, all right, the next thing that is happening is that you are able to, you begin to look for reasonable things to put into, because now you know that you have to just deliver anyhow. All right, are you guys with me? Okay, if you're with me and you understood what I've explained so far, kindly drop an emoji. All right, I want us to take it one step at a time. If you understand so far, please drop an emoji. Let me be sure that we're following my pace. All right, if you don't understand, also just type, I don't get it, or come again. All right, let me know that you need me to explain something, or to go over the explanations again. Okay, thank you. Thank you, Paul, for that. Now, remember I said interest rate, all right, what it does is it reflects how many percent, all right, you're going to have to pay back. All right, say, for example, you borrow $2,000, okay? If the interest rate is lower, all right, listen carefully. If the interest rate is lower, just imagine you borrow $2,000, all right? and the interest rate is like, say, 1%, 1% per year. All right, which means that after 1 year, if you want to pay back, you're simply paying back $2,020. Okay, it's easy for you to say, oh, well, let me just spend this. All right, you definitely might end up spending it on things that are not exactly profitable, all right, or things that are not exactly valuable. Exactly, let me put it like that, valuable. Okay, but if you're hearing that this money we're loaning out to you, all right, it's going to be accruing an interest rate of 3% per month. All right, it's going to be accruing 3% per month, which means that every single month there is $60 added to that $2,000. All right, which means that at the end of 1 year, all right, you would have accrued over 36% as interest on that amount that you have borrowed. So considering that now, and the fact that you don't want to get into debt, all right, you will look for the most meaningful or the most valuable vehicle or investment vehicle that you can put that money into, all right? You look for the best way to appropriate that amount of money, right? So this is how interest rate decisions affect the market, all right? So when the Feds begin to increase interest rates, all right, that decision actually improves the economy, all right? Why does it improve the economy? Because the investors and the money movers, all right, those who are transacting in high volumes, all right, because they are now under greater pressure to deliver, all right, they are under greater pressure to repay, all right, they have bigger targets to repay or to meet, all right, so they will look for the most valuable vehicles to put their funds into, all right, so that as they are putting their funds into it and the returns are coming in, all right, the returns are coming back into the economy to make that economy more valuable, all right, to improve the value in that economy. Okay, so when you read a fundamental publication and you see that they said the Feds are taking a more hawkish approach, all right, their interest rate decision is more hawkish, all right, what that means is that they are increasing interest rates, they are tightening conditions for borrowing money, all right, such that anybody who will still borrow despite the increase in rates, all right, must be borrowing because he has found an investment vehicle that can help him meet and exceed that expected return. Do you guys understand, please? Pope and Roderick, do you understand, guys? If you do, please let me know that you understand. And just type, I get it. Okay, Puzo, you want me to come again? Well, please, I think if you watch the recording, all right, the recording will be available on my YouTube channel later tonight. All right, when you watch the recording, I'm sure you will understand it. But if you watch the recording and you still don't get it, feel free to reach out to me in my DM, and then I'll take my time to just expound a little bit more on this. Okay. So what I'm saying is this, all right, when you wonder how interest rate affects stuff, all right, let me just give you an example. All right, just imagine that, say, for example, you want to borrow $2 million. All right, you want to borrow $2 million. And your initial plan was that when you borrow this $2 million, all right, you're going to use it to fund a trading account. All right, you fund a trading account and then you start trading. But now the person that is loaning you that amount of money now tells you that, all right, young man, this amount of money you're borrowing from me, all right, I am expecting 5% in. I'm expecting 5% interest per week, all right, from $2 million or $2 million naira. Okay. Now the question is, if you still go ahead to borrow this money at 5% interest per week, which means that at the end of 1 month, you are expected to have made at least 20% in profit on that $2 million, right? So, which means that for you to still go ahead and still borrow this money, it means you are confident that whatever you put that money into, all right, you are going to be able to make more than $2.4 million at the end of that first month. All right, because 20% of $2 million is $400,000. All right, so you are convinced, you are persuaded that what you want to use that money for, all right, you are persuaded that when you use that money for that venture, all right, when you put it into that particular scheme, all right, you are convinced that you will get nothing less than 20% interest from that venture, all right, which was why for people who are Nigerians, all right, you recall when there were things like MMM, all right, people took loans, all right, even at crazy interest rates, all right, because they knew that they were expecting 30% after 2 weeks, all right, only for the Ponzi scheme to crash, and then many people were thrown into debt, all right. The same thing has happened again and again, happened with several other organizations, even so-called forex investment companies, all right. Why do people borrow money to invest? Because they have hopes, all right, that what they are going to invest in will give them better returns, all right, will give them better returns than the interest rate. Okay, because if you are borrowing money and is accruing 20% interest per month, all right, you cannot invest it in something that will give you 10% returns. All right, because that just doesn't make sense. It means that you are still owing 10% at the end of each month. All right, so in fact, you cannot invest it in something that is going to give you 20% returns per month, because that just doesn't make sense. It means that you are not making any profit on top of that money. All right, so you'll be looking for something that delivers at least 25%, all right, so that you have 5% returns that is coming to you as your own profit margin. Do you understand now? So when the Feds increase interest rates, all right, what that begins to do is that it begins to put investors on their toes, so that whatever they are investing in, all right, they become more value conscious in their investment efforts, all right, and such that those who still go ahead to borrow, all right, there are people who are persuaded that they can get better returns than 20% in that period, all right, within that period, or more than the interest rate valuation, all right, during that period. Okay, so if you guys get it right now, can you drop a fire emoji in the comment section? Let me know that you guys understand what we've talked about so far. Give me some fire emoji, guys. Give me some fire emoji, guys. Let me be sure that we're together. Beautiful, beautiful, beautiful. All right. Thanks, guys. I'm excited that you guys get this. Okay, I'm really excited that you guys get it. That's for interest rates, all right. Another very high impact news, all right, is the CPI, all right, and like people have been saying of recent, oh, CPI is the new NFP, all right. Oh, no problem, Mr. Tim. They say, oh, CPI is the new NFP, all right. So let's talk about CPI a little bit. Okay, I hope you guys don't mind. Oh, come on. I hope you guys don't mind us talking about NFP a little bit. NFP, CPI, we'll talk about those right now as well. Please hold on, let me clear my charts. All right, beautiful. So let's talk about CPI. CPI is consumer price inflation, all right? And it's a value that tells us how much the price of goods, all right? How much the price of goods and services has increased. Okay, the CPI tells us, oh, this is how much the prices has increased. Now, the reason why CPI is becoming a more volatile fundamental factor compared to NFP right now, okay, The reason why it's like that is because currently the entire world, the whole world is in a recession. All right, the whole world is in a recession. And there is inflation in almost every continent, or I think even, in fact, it should be every continent. So right now, CPI is a publication or is a news release that is influencing people's emotions more. All right. So many more people are becoming more emotionally attached to CPI. All right. So whenever there's a CPI release, it either influences greed, all right, or it influences fear. All right. So when the CPI values indicates that the economy is improving, all right, people become greedy. All right. When CPI shows that the economy is bad, all right, people become scared of investing. All right. And as a result, the value of that economy or the value of that currency drops. All right. So as the value in the country reduces, all right, the money also reduces. Okay. So I'm going to discuss CPI and NFP in connection with employment change, all right, and unemployment rate. Okay, so let's get that done. Okay, so we'll talk about CPI. Okay, so we'll talk about CPI. We'll talk about CPI, employment change, and NFP, non-farm payroll. All right, so let's start with CPI. What does CPI tell us? All right, like I said, CPI tells us by how many percent, all right, consumer goods have increased in price. All right, that's what CPI basically tells. It tells us, oh, there's 2% increase in the price of goods, all right, there's a 1% increase in the price of goods, all right, and so on and so forth. Now, how do we approach that? Do we use that? All right, how does that become meaningful for everybody else to trade? Okay, the answer is simple. When there is inflation, all right, it means that people have to spend more money. All right, so when people have to spend more money, but a larger percentage of the economy is unemployed, what do you think will happen in that economy? If there's an increase in the price of consumer goods, all right, but the salaries are still the same, and in fact, many more people are jobless. All right, many more people are jobless. What does that tell you? It simply tells you that in the long run, all right, many people will be unable to afford stuff. And when they are unable to afford stuff, those who are also trying to sell to them will not be able to get their stuff sold, which means that in the long run, at the end of the day, all right, the economy performs poorer. Do you guys get it, please? Do you guys get it? All right. Let me give you a scenario. So imagine that somebody goes to import stuff. All right. Somebody goes to import stuff and is investing, let's say about 23 million. Sorry. These guys don't want my tool to be fine. All right. Come on. All right. So this guy is investing $23 million. All right. To buy goods that he's planning to come and sell. All right. But on getting those goods to come and sell, all right, there is an inflation. So the price of these goods has increased. Okay. Now remember, he just bought these things for 23 million. All right. Before the inflation hits, which means that by the time this person goes back to the market, all right, he is never going to find them again at this price. All right. He is never going to be able to get it at this exact price ever again. all right, because prices have increased. So when it brings these things to the market, all right, opens up its store and begins to sell this, all right, but unfortunately, more than 70%, or let's say 40% of the people that should patronize him are jobless or cannot even afford it. What does that mean? It means that these goods are going to have to spend longer, all right, in a stall, because if he sells them at a cheaper rate, all right, he's going to be losing, because at the end of the day, after selling all of this stock, he will not be able to go back to the market and still get them at this price. All right, so he's going to want to be able to sell at a price that will enable him to still be able to afford these commodities or these goods when it goes back to the market. Are you guys with me? Do you guys understand what we're talking about, please? If you get it now, please let me see in the comment section that you understand it now.
Yes, we understand.
Please only type. Do not unmute yourself. Please just type, all right, so that we don't compromise the audio quality. All right, beautiful, beautiful. So as a result of that, all right, when there is increase in unemployment, all right, increase in unemployment simply means that more people are becoming jobless. All right, so when more people become jobless, what happens? It means that the available value in that economy is dropping, because there are fewer people now that are providing value. All right, there is a reduction in the number of people that are providing value in that space within that economy. Do you guys understand now? So as a result of that, it tells us that that economy is going to perform a lot worse than it was initially or than before. Okay, so if we now have a situation where many more people are becoming unemployed, all right, and the consumer index or the consumer price inflation is also increasing, that means that there is an increase in the problems of that economy. So what happens? The currency will up faster. Yes, unemployment results in less consumption because people can no longer afford to consume as they usually do. All right? You can't compare how you currently live, all right, the way you currently spend. You can't compare that with the way you would spend if, for example, your income goes up by, let's say, 90%. All right? If your current income doubles, are you still going to spend the way you spend right now? That's an important question that you should answer. All right? So if your spending is going to change, all right, if your consumption is going to change, it means that your the improvement in your employment conditions, all right, is making you a better customer. All right, is making you spend more, is making you consume more. All right. So how does the NFP influence all of this? The answer is simple. Non-farm payrolls simply indicates the salary, the disburse of payments to non-farm workers, all right, to government workers that are not farmers, all right, excluding farmers and White House staff and some other sectors, all right. But it generally, indicates, disbursements, all right, salary payments. Okay. Now, what happens is when salaries get paid? The answer is simple. Are you guys with me, please? When salaries get paid, all right, it means that people now have purchasing power. All right, salaries have been paid, all right, people now have purchasing power. And as a result of that purchasing power that they now have, all right, it becomes something that helps them to be able to add up that, all right, it will show in the amount of consumptions. All right, that's one. Two, when the non-farm payrolls, all right, when there's an increase in the value of non-farm payrolls, all right, compared to the previous month, all right, let's say the amount they paid this month was higher than the previous month. All right, what that simply tells you is that they are paying more people, all right. They are paying more people, all right, or there's an improved there's an increase in the number of value providers. All right, because the government has just had to pay those who have been who have been providers of value. Okay, so when the amount they pay out has increased, it simply tells you that there's an increase in the number of people that are gainfully employed. All right, which means that there is now an increase in the amount of money that is available in that economy. All right, which now means that because of that, these guys can now come back to the market to patronize sellers more, all right, to buy more things. Okay, and all of this generally makes the economy more, more valuable, all right, and we know that when an economy becomes more valuable, what happens? The monetary value, all right, equates to the intrinsic value, all right. Whenever the intrinsic value is improving, all right, the monetary value will seek to balance up with it, all right. So do you guys understand this exposition that we have had so far? If you do understand, kindly drop an emoji in the chat box so that I know that you guys understand me loud and clear. All right, beautiful, beautiful, beautiful. Beautiful, beautiful. Okay, so this is where it gets interesting, all right, because this is where we're going to start talking about how to trade with the news. All right, and I know that this is like one aspect that many of you or a lot of you have been waiting for. All right, I know that you're familiar with the old story, whatever. All right, and you guys are just like, yeah, just show me how to use this. Okay, just show me how to use this. Sorry. All right, so people come and say, "Oh, just show me how to use this." I don't really want to understand how it works. All right, just show me how to use it. The answer is simple. So let's come to the charts. All right, this was a press release for GDP. All right, on Monday. All right, this was on Monday, okay, and it showed us the GDP, all right, for the Great Britain, all right, the gross domestic product, okay, and then if you check what it measures, it tells you that it measures the change in the total value of all goods and services produced by the economy, all right, and the usual effect, the actual greater than the forecast is good for the currency. All right, so how do I find the actual? This is where you find the actual. This is where you get the forecast, all right? And this is where you see the previous. All right, this is where you see the previous. Okay, so whenever the actual value for the GDP is better or greater than the forecasted value for the GDP, all right, it means that that economy is improving, all right? And that's why you see that the actual here was written in green color, right? Because that tells you that there was an increase in strength, all right, for the GDP. Okay, are you guys with me? But this is the value from August, all right? But this is the value for September, the one that happened last week, Monday, all right? And you see that this is 0.2%. The forecast was how many? 0.3%. All right, so there was a forecast of 0.3%, but the actual value came out as 0.2%, which means that that was lower than their expectation, than their forecast. All right, and what was that going to mean for the economy? It was going to mean that the GDP was going to drop. Okay, so let's go to a chart of GBP USD and see what happened. This line here represents the point where the moment where that news or that press release was, where that press release came out. All right. The press release came out at this point, all right, about 7 a.m. By my time, all right, around 7 a.m. And that was on the 12th of September. Okay. And the value showed us that GDP was supposed to be, losing value. All right, GDP was supposed to be losing value. But what do you notice? There was still a moment of, this upward price movement. All right. And this is the point where many people feel like, oh, the news is favoring the pound. All right, because they are seeing prices moving higher. But that's not true. All right. When you want to trade news publications, the first thing you want to do is you want to come to the daily time frame. All right. When you come to the daily time frame, you want to identify support and resistance areas on the daily time frame. So let me show you guys what we're talking about here. Can you guys see this? This was the previous break of structure that we had, all right? So that means that this zone can actually act as a support and resistance area, all right? So we've marked that. All right, so that's the zone that we are watching. Now, why did I say you go to the daily time frame? Because, financial institutions and, the large corporations, all right, they don't trade the lower time frames necessarily. All right, majority of their trading decisions are taken on the higher time frames, daily, weekly, monthly. All right, so what you're looking for, all right, is a support and resistance that that the institutions are going to be watching. All right, and we already have that here. Okay, so let's go to the 4 hours time frame. This was our previous break of structure. All right, and if you are a smart money trader, you can break this down a lot further by looking at this way. All right, another break of structure right here. All right, we have equal highs here. All right, we have equal highs there. We have a trend line liquidity over here. All right, and then price comes into this other block. All right, that is inside our resistance zone. All right, that's inside our resistance zone on on the daily time frame. Okay, so if I had used that other block, all right, what do you notice that would have happened to my entry? Can you guys see what my entry would have looked like? Can you guys see that entry? All right. So this is one of the secrets that many people don't understand. All right. And they try to blame it on, oh, whoever taught me Forex lied to me. They say things like, oh, the market was manipulated and all of that. All right. Even though this upward movement is a manipulation, okay, but it is a manipulation to an end. There's a purpose behind that manipulation. And what is the purpose? The purpose is to bring price into a more convenient zone for the investors, all right, for the corporate bodies to want to trade it. All right. So when the news release came out, all right, I know some people would have been watching this, all right, as the point where they want to sell from, only for them to have been, disappointed and the trade hits their stop loss. All right. So you just get to have entries like this when you understand how to apply what you're seeing on the charts, all right, or in the news, all right, to the charts. Okay. Another thing that you want to do is this: when you are trading news events, all right, please don't try to start trading news events with very small stop losses, with very tight stop losses. All right. And the reason why is this: even though your analysis may be correct, all right, in the long run, you may end up trade at a loss, or you may end up closing that trade or ending that trade as a losing trade. All right. Let me quickly show you guys This on GBP JPY. All right, so let's check for 12th of September. All right, it was around this time. So let's go to the daily time frame as usual. On the daily time frame, where is our support? Where is our resistance? I think it's safe to look at this entire area, all right, as our resistance. All right, that's the daily time frame because this is the previous high. I'm sure you guys can see that. That's the previous high, all right, and this was the previous break of structure. So let's take it to the 4 hours time frame. And what we are simply doing is that we're looking for an order block inside that 4-hour time frame. And that is the start of the order block. And see, if you like, you might want to refine this even to the lower time frames. That's on you. That's dependent on how in your analysis. All right, that's dependent on how confident you are in your analysis and its ability to play out. All right, so you can decide to even bring it lower to the 1 minute time frame, to the 1 hour time frame. All right, where this would be your OB. All right, but let's go back to the 4 hours time frame. And looking at this entry, all right, looking at this entry, an entry from either of these two other blocks, all right, what does this look like for you? All right, what does it look like to you? Would you be happy to take this kind of a trade? Or how would you feel taking this kind of a trade? Let me know, please. Just let me know in the comment section, all right, if you had the opportunity to catch a trade like this. All right, let's say you entered from somewhere around here. This is about 1:11. All right, entering from the first point, but entering from the second point, that's about 1:20. All right, 1:20 risk to reward. So when you guys want to trade the news, all right, these are things that you want to watch out for. If price is not yet at a daily support and resistance, run. All right, run. Why did I say that? If you notice all the analysis or all the setups that I dropped on FBS's website, all right, all the articles that I wrote for FBS, all right, all the articles I dropped for FBS, you notice that even the news could not change what I was forecasting. Even the news didn't change my analysis, all right? And the reason why is because despite the fact that there was news release, all right, there were fundamental factors, all right, it still didn't break the market structure on the daily time frame, all right? The support, the resistance still played out the exact way they were supposed to play out, all right? So these are things that you guys can start implementing in your trades such that you are confident to a larger extent, all right? To a larger extent. So if there's a news release, all right, and price has not yet gotten to a support or resistance on the daily time frame, all right, just expect naturally that they will manipulate the market one way or the other. They will manipulate it into that particular zone, all right? So you can wait for price to get to that point so that you take your entry, whereas other people are lamenting that they are in deep drawdown. All right? Are you guys clear about that now? So I'm only going to entertain one question, all right? Just one question. Just one question. If you have a question, please indicate in the comment section, all right? Or drop your question in the comment section so that I can get right into it for you guys. All right, so that I can get right into it with you guys. No, you said I should come again. What I simply said is simple. When you want to trade, go to the daily time frame, all right? Find the support and resistance. Wait for price to get there after the press release or after the news release. Spot your order block inside the support and resistance and shoot your shot. It's as simple as that. All right? So, this session, I couldn't show you guys how the intrinsic value of an economy or the monetary value of an economy. I was unable to show you how it dictates which investment value vehicle they put money into. All right, I'm not sure I was able to show you guys how it influences whether investors put money into crypto or into stock or into the currency markets. All right, or how investors decide whether to invest in in the major blockchain cryptos. All right, or whether they decide to invest into shitcoins. All right, or altcoins, all right, that are also called shitcoins. All right, so there are factors that determine which markets or to what extent, to what degree, all right, investors put money into certain things. All right, and that's why you discover that whenever there's increased inflation in the US, all right, US dollar itself drops. All right, the US dollar itself drops, whereas gold becomes what more people begin to buy. All right, and they are buying it because they want to secure themselves against inflation and the decrease in value of the dollar. All right, so there's a beautiful question in the chat box. Why is the USD gaining strength based on what I've said so far? The answer is simple. I believe I showed you guys. For those of you who have been following my articles on the FBS portal or the FBS website, I'm sure that you will not have that question. I'm sure that you guys will not have that question because in my article, you guys, how that this was the previous high from year 2002. All right, from year 2002. And price already broke above that high. All right, price already broke above that high. And price still came back to that exact point. All right, let me see if we can have that here. Let me go to the monthly time frame and show you that quickly. All right, this is not showing up to 2002, but there's a support. There's a support that was formed after the resistance got broken. All right, so the resistance got broken, price came back here. All right, and bounced. All right, but fundamentally, you want to know what influenced the US dollar. All right, that made it increase. Let's come and check. What day was it that the dollar gained strength? All right, that was like 13th of September. All right, that was like 13th of September. So let us check what was the news publication or news release for the dollar on 13th of September. So this was CPI, all right, CPI and core CPI. What do you see here? Is the actual lower than the forecast? No, you can see that it was written in green color. All right, it was written in green color, which means that the dollar naturally was going to gain strength. All right, was able to gain strength. Oh, okay, Mr. Tim, the websites are also available on the European website. The articles are available on the European website. So even after they redirect you to the EU version, all right, just go to the articles, all right, analytic articles. You'll see all of my analysis posted there. So, Mr. Temitope, have I answered your question now as we regards why the USD gains strength? It's gaining strength right now. Well, what you do is that after a news release, all right, or even maybe before the news release, identify the support and resistance on the daily time frame that price is approaching. All right, what's the support and resistance that price is approaching on the daily time frame? All right, and when you spot that support and resistance, wait for news to push price to that point. All right, that news release, wait for it to push price to that point. All right, to that point where your order block is inside the support and resistance on the daily. All right. And immediately you spot that, you can take your trigger. All right. So after the news release, you've confirmed, for example, that the currency is going to gain strength. All right. Wait for price to get to a support on the daily time frame before you shoot your shot. If you've seen that the currency is supposed to get weaker, wait for price to get to a resistance on the daily time frame before you shoot your shot. It is way safer and it will give you absolute sniper entries. All right. Absolute sniper entries. All right. So quickly before we wrap up for tonight and go into our market review session, all right, in one word, all right, or I want you guys to please just in the group right now, drop a review of what you have learned so far, all right, or how impactful this session has been for you guys so far, all right. Have you been able to learn something? Have you found this valuable, all right? Remember, value is equal to money, all right? Intrinsic value is equivalent to monetary value in ideal market situations. All right. So if this has been valuable to you, it's as though I have given you money. So please let me know what you feel about this session so far. Was it worth the hype? Are you impressed? All right. Just let me know in the comment section quickly. And if you're watching this on YouTube right now, all right, you can easily join us in the next one. All right. The link to the group, all right, is currently available, is attached in the comment section, all right, and in the description of this particular video, all right. So do join us for the very next one, and we can assure you it's going to be another amazing, session to learn more about the markets and improve your trading. Beautiful, beautiful, beautiful. Definitely the video will be on YouTube. You can always catch up, all right? You know that we value you guys so much, all right? So we don't want you to miss out on any value that we drop for you guys. All right, beautiful, 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 beautiful. So thank you so much, guys, for joining this amazing session. It's been another sensational moment with you guys, all right? So right about now, we're going to go into the market review for this week, all right? For this week, and then we're going to be looking at the commodities that have the highest probability that you can start to consider, all right? And then from there, we shoot, all right? So we're just going to take 5 minutes break. I'm going to play some soft music in the background, all right? So that you guys can enjoy yourselves while we wait, all right? So 5 minutes so that I can refresh my fleets, all right? And then we'll get into the charts, okay? Thank you, guys.